Hello, I'm cari.schulz, registered investment advisor since 1992, and this is my 2024 mid-year update. Let's get right to it. These are how the broad market indexes and economic indicators have done so far this year. The Dow Jones is up 3.78%, while the S&P 500 and NASDAQ are up quite a bit more, up 14.61% and 17.91%. The Russell 2000, representing more mid and small cap stocks, is flat. The international index is up a little over 8%. Commodities are doing well, as gold is up 12.45% and crude oil is up 14.76%. Interest rates have remained at 5.5%, inflation at 3.3%, unemployment is at 4%, and the 10-year Treasury comes in at 4.25%. In general, the markets and our economy have both been unexpectedly resilient this year. Stocks do still lack breadth as the big returns are concentrated in big tech and commodities. Interest rates look to remain unchanged until inflation proves to be under further control, and this was one of my 10 surprises to consider back in January, as consensus expressed a vastly different prediction of 6 rate cuts this year. Things have turned out much different than expected for longer than expected. So at this mid-year update, I'd like to shift the discussion to uncertainty in investing, why it's important to understand, and the modern approach to managing increased uncertainty. My lifelong fascination is with human behavior, and it's been the perfect interest to have for a career as a financial advisor. Helping investors make good decisions and studying the economy and the markets all have just as many elements of psychology and sociology as they do mathematics and statistics. And human behavior, all the way from the one individual to the collective of an entire nation, can be highly unpredictable. Traditional economic theory states that when humans are presented with various options under the conditions of scarcity, they would choose the option that maximizes their individual satisfaction. But for many complex reasons, we humans make decisions that are not always in our best interest. Our biases, habits, past experiences, and emotions enter into the actions we take. All this leads me to a new market phrase coined this year: Pent-Up exuberance. The president of the Atlanta Fed said this recently in a speech, referring to our renewed economic acceleration in the U.S., but it also captures the mood and behavior of investors. Many investors have been so fearful of an impending recession and stock market plunge that they've stayed on the sidelines too much. They've held too much cash while watching stocks reach record highs. Pent-up exuberance sounds to me like the new term for FOMO, or fear of missing out. We don't like to think of ourselves as being fearful or greedy, but as a human collective, these emotions drive us more than we think, and they certainly drive the investor collective. Remember, taking some profits at market highs, rebalancing your account, or just keeping a little dry powder for a potential market correction are all valid, time-proven strategies. What the Fed president was referring to is large amounts of cash that was held too long. And these large amounts of cash that just now buying into stocks for fear of missing out are helping drive the markets higher. And when this happens, it can create market bubbles that then burst. The further question is, if these pent-up exuberance behaviors create a bubble, when does it burst? Remember, tech stocks were in a bubble for many years in the 90s before they burst. It can be difficult to know what to do. Before we talk about the solution, let's recap where investors find themselves. Investors hold historically high levels of cash. Interest rates were expected to go down 6 times this year and did not. A recession and stock market correction were supposed to happen and did not. The distraction and uncertainty of our presidential election is coming soon. Stock volatility is almost twice what it was in the past 2 decades, but the average annual return has been about the same. In other words, the risk in stocks has risen, but not the reward. And lastly, economic uncertainty remains at all-time highs since the pandemic in 2020. The growing solution to uncertainty is a strategy called protective investing. The concept of protective investing has been around for a long time, but it's just now in the past handful of years that it's been available inside investment products that make the strategy easily available to all investors now. This growing trend includes ETFs, UITs, annuities, and structured notes. There's a lot to learn with these products, and it takes time to understand which one is right for your situation, if any at all. When our world and the markets change this much, new solutions inevitably come to the forefront, and it's a prudent idea to learn about them and see if they can help improve both our overall risk and return. Therefore, in the second half of this year, I'll be focusing my educational channel on investment strategies and investment products that are geared towards the protective investing strategy. We'll also discuss current trends that financial advisors are noticing about you, the investor. We'll call out the different types of risk that you're most likely overlooking. And of course, we'll finish the year by checking in on how my 10 2024 surprises did for the year before we predict how 2025 will turn out. As always, talking to you is the best part of my job. Most of my clients are already using protective investment strategies or protective investment products. But if you're not sure and you still want to learn more, drop me an email. And stay tuned for the new videos this half. I think you're going to like them. See you there.